Welcome to RSM Tax Summit Week 2021. Today's presentation is Global Indirect Tax, Hot Topics, and Recent Updates. At this time, I'm pleased to turn our call over to our first presenter, Steve Butler. Steve?
Thank you, Alison, and good afternoon, everyone, and welcome to our webcast discussing Global Indirect Tax, Hot Topics, and Recent Updates, specifically focusing on value-added tax, VAT, and goods and services tax, GST. We're very pleased to have you join us for the session and hope you find the next hour of content interesting and insightful. The majority of the content that we'll cover today will be focused on US companies doing business around the world, but where we do refer to a US company in our example, this could often be interchanged with a Canadian company or any other non-resident legal entity. As a brief introduction, my name is Steve Butler and I lead RSM's Global VAT team in the West region based in LA. As I'm sure you can tell, I'm originally from the UK, but I've been in the US for over 8 years and specialize in advising US multinationals on global VAT and GST matters. I'm joined this morning by my colleague Ibrahim from RSM Canada.
Thanks, Steve. My name is Ibrahim Hatia, and I'm a Senior Director in the Indirect Tax Group in RSM Canada's Toronto office. A large part of my practice, especially during this calendar year with all of these changes, consists of advising businesses outside of Canada who are doing business with Canadian customers. Thank you for attending today, and I look forward to spending the next hour or so with Steve as we go through some of these updates. So here's what we have planned for today. We'll first discuss some of the tax challenges related to the digital economy, including the cross-border movement of low-value goods and the cross-border supply of digital products and services. We'll then speak specifically about changes in Canada related to the application of GST/HST to the cross-border supply of digital products, services, and goods. We'll then continue discussing some changes in various Canadian provinces. I'll then pass it back to Steve to talk about the EU's definitive VAT regime, some indirect tax recovery opportunities, and some global indirect tax trends. Our learning objectives for today are to help participants to be able to describe some key indirect tax considerations for businesses that operate in the digital economy, understand some VAT and GST recovery opportunities, describe the EU's upcoming definitive VAT regime, and summarize global updates on indirect tax compliance and reporting. Steve, back to you.
Excellent. Thanks, Ibrahim. So we're going to kick things off this afternoon by talking about VAT updates in the digital economy. This has been an area with a significant number of changes in recent years, and with the rise of online activity as a direct result of COVID-19 and stay-at-home orders, it continues to be an area of focus for global taxing authorities. To provide some context around the ongoing VAT changes to the digital economy, we need to go back to October 2015, when the OECD, the Organization for Economic Cooperation and Development, released various publications in its BEPS, standing for Base Erosion and Profit Shifting Initiative. Specifically, Action 1, addressing the tax challenges of the digital economy, provided 2 key indirect tax recommendations. The recommendations focused on the implementation of what we call the destination principle. That is, VAT and GST being consumption taxes should be chargeable in accordance with the destination or location of the recipient, essentially where the benefit of the service is received and consumed. Applying this to the 2 focus areas, the OECD recommended that for digital services, which are generally defined as any service delivered via the internet with no or minimal human intervention, such as online streaming, games, music, SaaS, web hosting, etc., these should be taxed in a B2C context, that is provided to private individuals or non-business customers, by way of a non-resident registration. In the absence of such a mechanism, suppliers of digital services to consumers were typically not being taxed, resulting in distortion of competition between domestic and foreign players, and more importantly, lost VAT revenue for tax authorities. The second recommendation focused on e-commerce for the sale of physical goods, and specifically ensuring the efficient collection of taxes on what we call low-value goods when they were being shipped cross-border to private individuals. An example of this would be a US retailer selling consumer products to customers in the UK, EU, or Australia. Under old rules in many jurisdictions, low-value goods below a certain threshold were not being taxed at the time of import due to what is known as low-value exemptions. These rules allow goods to pass into a country free and clear of import taxes such as VAT, GST, or customs duties when they are under a certain dollar threshold. Goods above that threshold are typically subject to import VAT and duty when they are customs cleared, and those taxes are generally payable by the importer of record depending on the specific contractual terms of the sale. By introducing a non-resident registration mechanism for suppliers of such low-value goods, tax authorities could again protect domestic companies from foreign tax-free imports and increase tax collection by legislating non-residents to collect tax at the point of sale. What has resulted since the OECD released BEPS Action 1 is that many tax authorities around the world have introduced new VAT and GST legislation specifically aimed at companies operating in the global digital services and e-commerce industries. In the digital services space, some 90-plus countries, including the EU, UK, Switzerland, Australia, Japan, South Korea, India, and Mexico, to name just a few, have introduced legislation requiring non-residents to collect and remit VAT on certain transactions. For those of you familiar with the Wayfair sales tax changes in the US, you can think of this as global Wayfair under principles of economic nexus. The VAT landscape with respect to supplies of low-value goods is still somewhat limited due to the fact that in many countries, VAT on such transactions is still actually collected at the border, and low-value exemptions either don't exist or the tax authorities don't perceive a significant tax benefit in closing the loophole. However, in addition to the EU, UK, and Australia, New Zealand, Switzerland, and Norway have similar rules, with Singapore proposing to introduce such rules from January 1, 2023. These rules also typically have some form of marketplace facilitator model, requiring marketplaces to collect VAT or GST on taxable supplies that they are facilitating. This is a general trend that we are witnessing in the VAT world and extends across to supplies of digital services as well. This next slide depicts the global indirect tax landscape for supplies of low-value goods, which, as you can see by the lack of green, are still somewhat sparse and concentrated in certain parts of the world. In all other jurisdictions, e-commerce companies selling to private individual consumers typically are not required to collect or remit VAT, provided the customer is the importer of record for customs purposes. To give you a little more context in relation to these rule changes, this table provides a brief overview of the rules in Australia, New Zealand, Norway, Switzerland, and the UK. All of these rules have been implemented since July 2018, and the jurisdictions have different registration thresholds ranging from nil in the UK and EU up to around $108,000 in Switzerland. The definition of what a low-value good is varies across jurisdictions, from £135 sterling in the UK to £1,000 Australian dollars down under. This threshold is typically also based on the consignment value of the goods, so it is important to understand, for example, if multiple purchases are shipped in one bundle or potentially shipped in separate packages. As a slight nuance, the Swiss rules aren't based on the dollar amount of the goods per se, but are instead based on the amount of import taxes due. For example, if the amount of import tax due exceeds 5 Swiss francs, then VAT is due at the time of import. And if the tax due is below 5 Swiss francs, the seller may be required to collect and remit Swiss VAT via a direct registration with the Swiss tax authorities, assuming that they exceed the registration threshold. As mentioned, all of these rules have some form of marketplace facilitator law, meaning that if the goods are being sold via an online marketplace or platform, the marketplace or platform is liable for the VAT due instead of the underlying seller. This is a mechanism to ensure tax collection is in the hands of the main marketplaces as opposed to tens of thousands of underlying sellers utilizing those services. The EU rules, which were effective from July 1, 2021, have a €150 low-value threshold. What this means is for a US company supplying goods to EU consumers and shipping those orders into the EU from anywhere outside of the EU, is that there is a difference in the VAT treatment depending upon whether the €150 threshold is exceeded or not. In the top diagram, the sale is below €150 in value. This means that the US company may be required to collect and remit VAT on that sale via an EU VAT registration. In such a case, the US company may need to appoint what is known as an intermediary, essentially a fiscal representative, and register for an EU special scheme known as the Import One-Stop Shop. This scheme allows taxpayers to declare the VAT collected on the sale of low-value goods to all EU member states by submitting a single monthly VAT return to just one EU member state. As a little quirk to the EU rules, it's worth noting that this is technically an optional scheme, Specifically, there is no obligation or liability to collect VAT at the time of sale or utilize the import one-stop shop. If the US company doesn't register for this scheme, the VAT will instead be collected at the border at the time of import, but this could result in shipping delays as the goods will not pass through a specific green lane for low-value goods. This can result in additional clearance costs charged by the freight forwarder, and this approach may also lead to a poor customer experience due to the customer potentially being required to pay the import VAT and/or duty to a local mail operator in order to receive their purchase. The bottom diagram shows that if the sale or consignment is above €150 in value, the current status quo will remain. That is, VAT will be collected at the time of import and payable by the importer of record. This mismatch in VAT treatment between goods above and below this value demonstrates the practical challenges of implementing these rules for businesses that may sell goods in consignments of varying values. We have seen certain companies limit values to either above or below the threshold to ensure a consistent application in the rule set for both the taxing decision as well as how the imports are practically handled by their freight forwarders. While we don't touch on this directly in these slides, the EU also changed a significant number of other e-commerce rules from July 1, 2021, including removing the old distance sales regime that you may have heard of, implementing very broad marketplace rules where the underlying seller is not established in the European Union, and then extending the one-stop shop schemes for intra-EU supplies of certain goods and other services. We'll touch on the one-stop shop scheme in a little more detail later when we talk about the EU's definitive VAT regime. All of these rules mean that if you're a US company supplying e-commerce products to customers in the EU and around the world, it's important to understand your VAT obligations based on the specific fact pattern and rule set applicable to the business. More new legislation is expected in other parts of the world, so we certainly recommend keeping a close eye on this if your business may be impacted. Okay, so now we're going to move over to the VAT landscape for digital services. As you can see from this map on the slides right now, many more jurisdictions have implemented such rules. We're currently at somewhere around 90 jurisdictions, with the majority of the Western world covered. The main gaps in legislation, as you can see by the blue, typically exist in parts of Africa, the Middle East, and then some parts of South America. As mentioned during the introduction, the vast majority of these countries only require non-residents to register when making B2C supplies of digital services. This is because, unlike a business, private individuals are not able to self-account for VAT under what we call the reverse charge or self-assessment mechanism, a little bit like use tax in the US. For the purpose of these rules, a B2C supply is typically defined as a sale to a non-VAT registered customer, although the specific definition does vary across jurisdictions. Where a business is providing digital services to customers around the world, the foreign customer is typically required to self-account for any VAT or GST due. In those situations, the US supplier is not required to charge, collect, or remit any VAT, but has the burden of proof to substantiate that customers are VAT or GST registered by collecting and validating tax ID numbers as required by local country law. As such, it's important that this step is added to a Know Your Client or client onboarding process. That said, there are, however, a few countries that don't follow this approach and require B2B suppliers of digital services to register, collect, and remit VAT. This includes South Africa, Russia, and Malaysia, and soon to be the Philippines. These jurisdictions catch out many US companies selling overseas who can unknowingly be creating indirect tax liabilities, as well as late registration penalties and late payment interest. Therefore, for any business providing digital services globally, it's critical to understand the global VAT landscape, the types of customers the business sells to, and whether there are any potential VAT registration obligations. This area continues to evolve at a rapid pace, so it's also crucial to monitor and track legislative developments in key foreign markets. The final slide in this section shows the number of jurisdictions implementing these rules has steadily increased since the OECD released its recommendations in 2015. This includes New Zealand in 2016, India, Russia, and Australia in 2017, Turkey and Colombia in 2018, Bahrain and some of the other Canadian provinces in 2019, and then a number of countries waiting until 2020 to introduce their version of this legislation. Countries that have recently implemented such rules include Cambodia, Oman, and back in July of this year, Canada at the federal level. And with that, I'll pass across to Ibrahim to talk to the Canadian rules.
Great. Thank you, Steve. So first in our discussion of the changes in Canada, we'll talk a bit about services and digital products and the new GST-HST rules that took effect on July 1 of this year. So until June 30th of this year, non-residents who sold services or digital products to customers in Canada were generally not required to register for GST-HST if they did not have a physical presence in Canada. As Steve mentioned earlier, this physical nexus test has now given way to an additional economic nexus test, whereby a non-resident of Canada can generally only stay out of the GST-HST system if it is not required to register for GST-HST under both the physical and economic nexus test. So the list of services and digital products that are captured by the new rules is quite broad, and it includes the obvious culprits like online streaming services, access to gaming platforms, and other mobile apps, but it also includes traditional services such as accounting, legal, and consulting services, investment management services, and memberships in not-for-profit organizations. Then you've also got other digital products and services that might not be as obvious, such as digital healthcare and therapy and online gambling. Now, obviously, this list is not exhaustive, and there are some exceptions, such as for an intangible property that cannot be used in Canada, or services like legal services that might relate to real property located outside of Canada. However, if you're a business that's supplying any services or digital products to customers in Canada, it would be prudent to review if you're subject to these rules. So once you've determined that your products or services are subject to the rules, you'll need to confirm if you meet the thresholds required for registration. So a non-resident who is selling services or digital products to customers in Canada is required to register for GST-HST if in a 12-month period, its sales to customers resident in Canada who are also not registered for GST-HST exceeds $30,000 Canadian dollars. This generally captures all B2C sales, but it also includes certain B2B sales because not all businesses are registered for GST-HST. For example, many charities, NPOs, organizations in the MUSH sector, certain financial institutions, and pension plans may not be registered for GST-HST. Therefore, it is important that all businesses track the GST-HST registration status of their customers, even if they're only making B2B sales. The new rules also impose a new requirement on distribution platform operators, as Steve mentioned, marketplace facilitators, or DPOs, to register for GST-HST in respect of sales made on their platform. These rules capture online marketplaces and app stores and other similar businesses. The rules typically do not apply to DPOs that meet the definition of excluded operator, which generally means businesses who merely provide advertising or payment processing services. It is, however, a detailed definition, so it's important to review that definition to find out if you are, in fact, an excluded operator. So a DPO who allows for the purchase of services or digital products on its platform is generally required to register for GST-HST if, in a 12-month period, sales by businesses who are not resident in Canada and who are not registered for GST-HST to Canadian resident purchasers who are also not registered for GST-HST exceed 30,000 Canadian dollars. Where this occurs, the tax collection and reporting obligations in respect of non-resident unregistered businesses on the platform shift to the DPO. So obviously this will create additional risk for the DPOs because they now have a tax obligation that did not exist prior to July 1. Additionally, DPOs will have similar requirements to now track the GST-HST registration status of customers using the platform, as well as the registration status of vendors using their platform to determine if the obligation has shifted. The new rules allow for a simplified registration process that doesn't apply to Canadian resident businesses. If a business chooses to use a simplified registration process, it only needs to charge and collect GST-HST on sales to purchasers who do not provide their GST-HST registration number. This means that simplified registrants will need to track their customers' registration numbers, which is not something that is required of businesses who register under the regular method. Businesses who use a simplified registration method cannot claim input tax credits, or ITCs, to recover the GST/HST that they pay on their costs. However, we expect that most businesses who register under the simplified method will not have many, if any, GST/HST taxable costs, so there might not be much of a downside there. Some upsides to the simplified registration method include that businesses can now report their GST/HST return and remit their amounts owing in foreign currency. Currently, foreign currency that's prescribed for this for these rules is the U.S. dollar as well as the euro. Additionally, non-resident businesses who register for GST/HST under the regular method are required to post a security deposit of up to $1 million. This requirement does not apply to businesses who use a simplified registration method. So what does this all mean? Well, for starters, these changes represent a significant increase in the global indirect tax net, and many businesses who sell remotely will be required to register for GST/HST or VAT in various jurisdictions across the globe. The changes will also increase costs for your customers, as they will now be paying sales taxes on products and services that they previously purchased free of tax. There will be necessary changes to ERP and billing systems, or if you're using a tax engine, changes to the tax engine. Businesses will need to track purchasers' registration numbers, and DPOs will have to do the same. And DPOs will also need to track the registration status of vendors using their platforms. Additionally, because the requirement to collect tax will shift to DPOs in many cases, DPOs will now have additional tax liabilities that they didn't have prior to these changes. Finally, businesses who are required to register for GST/HST but cannot yet do so because of the system changes required or some other commercial reason, they should consider applying to the Canada Revenue Agency, or the CRA, for administrative relief until June 30th, 2022. Although these rules kicked in on July 1 of 2021, the CRA has agreed to provide administrative relief in cases where a business applies for such relief, and if that request for relief is granted by the CRA. So moving on, I'll talk a bit about the changes for businesses who sell tangible goods to customers in Canada. So these new rules are intended for non-resident businesses who sell tangible goods to consumers in Canada and DPOs who facilitate such sales where the goods are delivered from within Canada to a consumer in Canada. Similar to the rules discussed previously, the liability to collect GST/HST will shift to DPOs in many cases. The goal of these changes is to reduce the tax gap that existed because many non-resident businesses were selling tangible goods from warehouses located in Canada, but they weren't registered for GST/HST. So we'll talk first about the application of the rules to DPOs. So DPOs will be required to register for GST/HST if sales on the DPO's platform by unregistered sellers exceed 30,000 Canadian dollars in a 12-month period. The simplified registration option that I discussed previously is not available when it comes to tangible goods. Note that this threshold calculation does not include sales of tangible goods that are shipped via mail or courier from a place outside of Canada to a customer inside of Canada. Accordingly, this calculation primarily captures goods that are stored in Canada. Once registered for GST/HST, certain Canadian sales on the platform will be subject to GST/HST. If the sale is made by an unregistered vendor and the goods are shipped from within Canada, the tax liability will shift to the DPO. Alternatively, where the vendor using the platform is already registered for GST/HST, the obligation to collect, report, and remit the GST/HST will rest with the vendor. However, the DPO and the vendor may be able to jointly elect to have the DPO report and remit the GST/HST on the DPO's GST/HST return. DPOs will also gain the entitlement to claim input tax credits to recover import GST paid by unregistered vendors where the tax liability has shifted to the DPO. However, in practice, we believe that this will be difficult for DPOs to track. Note that the tax liability will not shift to DPOs in the case where the goods are shipped via mail or courier by a GST/HST unregistered vendor from outside of Canada to a customer in Canada. Generally, we expect the applicable sales tax to be collected on these sales by the Canada Border Services Agency at the time of import. Non-resident businesses who sell goods directly and not through a DPO, so for example, from the business's own website, will be required to register for GST/HST if they exceed the $30,000 threshold as well. This threshold includes all sales made in Canada to purchasers who are not registered for GST/HST other than goods that are shipped via mail or courier from outside of Canada. However, once this threshold is exceeded and registration is required, GST/HST will apply to all sales that are delivered or made available in Canada by the vendor, including sales that are delivered from outside Canada via mail or courier. Note that in this case, vendors who are required to register for GST/HST will be entitled to claim ITCs to recover the import GST that they pay at the border at the time of import. I just want to make it clear that these rules, because there is no simplified registration method here, once you become registered, tax applies to all sales made by, to an applicable taxable sale in Canada, whether it's made to a registered purchaser or an unregistered purchaser. So what does this all mean? Businesses and DPOs will need to determine if they are required to register for GST/HST. DPOs will also need to track sales based on whether the vendor is registered for GST/HST or not, and whether the goods are shipped via mail or courier from outside of Canada or not. Businesses who sell directly from their own sites and DPOs will need to ensure that their systems can properly charge and track the GST/HST, meaning system changes will be required. DPOs and certain fulfillment warehouse operators will be required to file a new annual information return regarding sales made through the DPO or the warehouse. However, no details on the returns have been released yet. Again, the CRA is granting administrative relief in some cases until June 30th, 2022, but businesses and DPOs who cannot comply before then will need to apply for the relief. So before I pass it back to Steve, I'll talk a bit about the QST and TST changes that have occurred or will be occurring in Canada. The Canadian provinces have been expanding their provincial rules well before these GST/HST changes. For instance, Saskatchewan introduced changes that required remote sellers to register for Saskatchewan PST back in 2017 and further expanded those rules in 2020 for marketplace facilitators. Quebec has had rules in place since 2019 for remote sellers and has harmonized those rules to line up with the GST/HST rules effective July 1, 2021. Similar to the CRA, the Quebec tax authorities are providing administrative relief until June 30th, 2022 in certain cases, provided the business has applied for such relief. Effective April 1, 2021, British Columbia has expanded its PST rules to require certain non-resident vendors to register for and charge and collect BC PST. Finally, Manitoba intends to change its rules effective December 1, 2021 to require certain non-resident businesses to register for Manitoba PST. So as you can see, non-resident businesses who sell to customers in Canada will now need to consider their provincial sales tax obligations in addition to the previously discussed GST/HST obligations. And with that, I'll pass it back to Steve.
Excellent. Thanks, Ibrahim. Very interesting updates there. And I think it's certainly fair to say that for digital services, the majority of the rules across Canada, both at the federal and provincial level, do follow the general rules we see around the world in terms of the OECD recommendations. But for suppliers of physical goods via online platforms or by businesses, there's certainly a few quirks in Canada with the local rules, the cross-border rules, and various other considerations. So a pretty complicated landscape in Canada for sure. Excellent. So we're going to move on now to the next topic, which is discussing what's known as the EU's definitive VAT regime, which is proposed to make significant changes to intra-EU B2B supplies of goods. Just as some background before we dive in here, the European Union, which now consists of 27 EU member states following Brexit, is governed by a single EU VAT directive. This provides a framework for each EU member state to follow to ensure consistency across the EU single market, although the interpretation and application of specific rules can vary across the European Union. However, despite the EU VAT directive being around for many decades, it is still technically temporary legislation and somewhat outdated. For example, the current rules for cross-border business-to-business supplies of goods has been in place since 1993. This is a large area that the EU Commission would like to change to improve the overall functioning of the EU's VAT directive for businesses and prevent VAT fraud, which is a major issue in the European Union, particularly around intra-EU supplies of physical goods. It's estimated that the EU is losing around 50 billion euros of VAT revenue each year as a direct result of such fraud. Many measures have already been implemented, but this continues to be an issue at the broad European Union level. Last year, the EU implemented a series of so-called quick fixes to improve the current day-to-day functioning of the VAT regime, again, all related to cross-border supplies of physical goods. This clarified 4 key areas, including the documentation to support cross-border zero-rated supplies, clarifying the rules for cross-border chain transactions where goods are drop-shipped from party A to, let's say, party C in a supply chain, harmonizing the VAT rules for call-off stock, which is where goods are kept in the destination country and owned by the supplier, but waiting for a customer to call off and utilize the specific goods, and then finally the introduction of a mandatory VAT ID check for inter-community supplies. The EU's definitive VAT regime is based on certain cornerstones or pillars. This again includes a destination principle for cross-border supplies of goods, specifically taxing sales of goods in the jurisdiction where the goods are being shipped to. In addition to this, the proposed changes also seek to confirm that the vendor is liable for charging and remitting VAT for intra-EU supplies of goods, which is a significant change compared to the current state, as we'll discuss shortly. Finally, the EU is very keen to continue to extend its one-stop shop schemes. These are special schemes that allow businesses in certain situations to remit VAT across all EU member states through just a single VAT registration in one EU member state, as opposed to being liable to be VAT registered in many, if not all, 27 EU member states. The tax authority to which the VAT is remitted then essentially acts as a paymaster and remits the VAT to the other tax authorities across the EU. The proposals for the EU's definitive VAT regime are currently planned to be effective from July 1, 2022. However, this is very likely to be delayed given the implementation timeframe between now and July of next year, although there's been very little word on the new rules and when we expect them to be introduced. Nevertheless, businesses that are making cross-border B2B supplies of goods within the EU and will be affected by the rules should begin to analyse and consider the impact on their operations. To give some context regarding the proposed changes, it's important to understand the current state of the cross-border shipments of goods within the European Union. We have a couple of diagrams on this slide to demonstrate exactly what will happen in the current state and then the future state. At the moment, let's say a Dutch business supplies goods to a German customer and the goods are physically shipped from the Netherlands to Germany. The Dutch supplier can zero-rate the supply provided it obtains and validates the VAT number of the German customer, as well as obtains and retains proof that the goods have left the Netherlands. The German business customer is then liable to self-account for what we call acquisition VAT, essentially accounting for VAT as if it were the supplier and then being able to reclaim the VAT at the same time. This typically means that the VAT is just an in and the corresponding out, resulting in no net VAT payable and no cash flow implication for the German purchaser. Under the proposed rules for the EU's VAT definitive regime, taking the same situation, the Dutch supplier of the goods would now be required to charge the German customer German VAT on the supply as the goods are being physically shipped to Germany. The Dutch business customer would then remit the German VAT to the Dutch tax authorities via the one-stop shop scheme, and the Dutch authorities would then pass the VAT across to the German authorities. The German business would then reclaim the German VAT charged by the Dutch business on its German VAT return. I hope that makes some degree of sense to everyone. This obviously represents a very significant change to the current operation of cross-border supplies within the EU and would impact all businesses making such supplies from a tax compliance, invoicing, and ERP or tax engine perspective. This also impacts companies making such purchases and would in theory result in negative VAT cash flow implications for the purchaser, who previously wouldn't have paid VAT on such purchases, but would now be required to pay the VAT and then reclaim it via the submission of its VAT return to the local tax authority. There is a potential exception to this rule for what's known as a certified taxable person. If a business meets certain conditions, they will be able to continue to purchase goods free of VAT and then self-account for VAT under the acquisition rules that we just discussed on the prior slide. Accordingly, in such a scenario, the supplier will be able to zero rate the sale instead of charging German VAT. The main benefit of this for a business is that they will not suffer the adverse VAT cash flow delays that we just mentioned. To become a certified taxable person, it is expected that the taxpayer will be required to prove their compliance position and demonstrate their good standing. It remains to be seen how complex or lengthy this process will be for taxpayers and how this will be standardized across EU member states. It will likely be a case for companies to weigh up the cost benefit of going through the certification process versus the economic costs of the VAT cash flow delays. This distinction will, however, provide some added complexities for business supplying to both certified taxable persons and non-certified taxable persons, as they will need to be able to make taxing decisions based upon the specific status of their customers across the European Union. Given the dramatic nature of these changes, there's quite a bit of work for businesses to do to prepare for these rules. For example, businesses should begin to analyze the impact of the proposed solutions on its EU operations, evaluate the necessary changes to the business to ensure compliance with the rules, including systems and ERP requirements, as well as VAT invoicing requirements, and then assess or consider whether applying for certified taxable person status would be beneficial for the business. While there are a number of open questions at this moment in time, what we can certainly say is that there will be more updates on this topic in the coming months. Okay, so on to our next topic now, and the penultimate topic that we will discuss during this webcast is with respect to indirect tax recovery opportunities. Unlike most US sales taxes, VAT and GST are creditable or recoverable taxes. That is, if a business incurs VAT or GST as part of its business operations, there is the ability to take a credit or receive a cash refund of the VAT or GST, provided certain conditions are met. A fundamental principle of VAT and GST is that for most businesses, any VAT or GST incurred on purchases should not be a cost of doing business. There are a few exceptions to this, particularly in the financial services industry and other industries that have VAT or GST exemptions. Additionally, there are many situations that we see where US companies are indeed incorrectly charged VAT or GST by foreign suppliers, where a VAT exemption or zero rate should apply, predominantly around the procurement of cross-border services. In these cases, the refund of VAT should be obtained directly from the supplier who is incorrectly charged the tax, as opposed to from the taxing authority. In order for VAT and GST to be recoverable, there are specific conditions that should be met. The main conditions are typically that the VAT incurred was legitimate, VAT that was due to be paid or charged by the vendor, the business incurred the VAT in the course of its business activity and will use that cost for its business, the business holds a valid VAT invoice or other suitable documentation to substantiate the recovery of the tax, and the taxpayer claiming the refund is either registered for VAT purposes or able to reclaim the VAT via what we call an overseas VAT refund claim. These types of opportunities primarily exist in the UK and the European Union. There are many situations that we encounter where a US company has the opportunity to reclaim VAT that they incur. Some common examples of situations where we see companies not reclaiming VAT include expense categories such as employee expenses for travel and subsistence, where let's say a company has a workforce that regularly travels to client sites and incurs VAT on hotel meals and certain travel costs, although as I'm sure everyone appreciates, we're seeing less of this due to the impact of COVID-19. Another scenario is where companies import business assets into third countries, such as servers, equipment, and even inventory. We sometimes see situations where companies have paid import VAT but have not sought to reclaim that import VAT, and therefore there is an opportunity to either claim that through a VAT return or potentially file an overseas VAT refund claim. And one example linked to a particular fact pattern that we'll walk through in the next slide is the purchase of assets for testing purposes in the life sciences industry, such as comparative products or other drug products utilized in the manufacturing process. Ibrahim, I'll just sort of pause here and see if there's any specific examples that you'd like to talk about from a Canadian perspective.
Thanks, Steve. Yeah, I think a lot of what you've mentioned applies to Canada as well. But because we also have provincial level sales taxes, some of which are similar to sales and use taxes, there are often other quirks, and sometimes they end up being compliance issues that arise here. So, for example, a simple one is it's important to ensure that if a business is being charged, say, PST or QST, that business is not claiming that as an input tax credit on its GST return. Similarly, if a business, especially a non-Canadian business, is paying QST or PST to vendors, it's important to ensure that, one, the QST or PST was in fact payable and an exemption of some sort did not apply. So, for example, a zero rating exemption because they're non-residents, or even a resale exemption for PST because it's being resold. And in the case of QST, ensuring that the QST is recovered as an input tax credit on the QST return if that business is in fact registered for QST. But other than that, I think everything that you noted also applies to Canada.
Yeah, excellent examples there, Ibrahim. And I think it's always a great rule of thumb as a US company to query whether or not you should be paying VAT or GST. And if you are, making sure that the business is thinking about how that will specifically be reclaimed. Okay, so we're going to talk briefly now about a specific example that relates to a relatively recent rule change in the UK relating to the import of goods for clinical trial purposes. This example can translate across to other industries such as toll manufacturing supply chains, but this is a most common fact pattern that we see. In this scenario, as we've got depicted here on the slide, let's say a US life sciences company, which can be pre or post revenue, has manufactured a drug product which it has in the US. If the US company then ships that product to a UK clinical research organization, a CRO, for clinical trials, UK import VAT at the current standard rate of 20% will be due when the goods are imported into the UK. Historically, and prior to the rule changes, the UK CRO would likely pay and reclaim the import VAT despite not having legal ownership of the goods being imported to the UK. Title and right to dispose of the goods would typically remain with the US company. This would mean that the US life sciences company would not be responsible for paying and reclaiming the import VAT. However, following a recent change of interpretation by HMRC, the UK taxing authorities, only the legal owner of goods is able to reclaim the import VAT. This means that the CRO is no longer able to reclaim the import VAT. On the assumption that the US company isn't registered for UK VAT purposes and doesn't have an obligation to do so, as it's not possible to just register for UK VAT for the purpose of reclaiming VAT, the US company will likely be required to reclaim the VAT via an overseas VAT refund claim. This process has very strict time limits for claims to be accepted, which is just 6 months after the end of a 12-month claim period, and certain documentation, including original copies of invoices and import documents, are required to be submitted. We often see US companies paying import VAT and potentially not reclaiming that VAT. Specifically in the UK, the claim period runs from July 1 to June 30, and claims must be submitted and received by HMRC on December 31 at the very latest. That means if a company has incurred any VAT from July 1, 2020 through to June 30, 2021, the claim has to be submitted to HMRC by December 31, 2021. So there's just under 2 months left to finalize and submit claims. HMRC does not accept late claims, so any VAT incurred in the period would not be recoverable unless a claim has been submitted by that date. Therefore, for any business in the life sciences space or with a similar fact pattern, we would certainly recommend reviewing this and seeing whether or not the business has potentially paid UK or EU import VAT and has the opportunity to submit a refund claim. Ibrahim, I'll turn this back over to you quickly to sort of talk about the scenario in Canada, because I think the Canadian approach and interpretation here is slightly different to what I've just mentioned for the UK.
Yes, that is correct. In Canada, we do have the option for toll manufacturers, for example, or in the example that you gave, to claim the import GST under existing rules?
Yeah. It's a bit of a trend we're seeing around the world, moving to the concept of only the legal owner of the goods being able to reclaim the import taxes, but a number of countries do allow parties that have what used to be called in the UK a significant economic interest in the product. For example, they were providing services in relation to the goods to reclaim that import VAT. Excellent. And finally, we're going to talk very briefly about some key global indirect tax trends that we are seeing around the world. As we discussed, these are mainly focused on enforcement and compliance, as tax authorities are seeking to increase tax revenues from VAT and GST and ensure that taxpayers have the relevant controls to actually remit and report their indirect tax positions. The way that tax authorities are generally doing this is by placing more reporting and administrative obligations on taxpayers, which I'm sure everyone is delighted to hear about. For example, one of the key themes is that many taxing authorities are implementing new reporting requirements on taxpayers that are commonly referred to as near-time or real-time reporting. Such rules require businesses to submit reports of transactions either as they occur or shortly after they occur, so that the tax authorities have the underlying information in order to review and audit the submission of VAT returns. Given that VAT and GST are indirect transactional taxes, if a tax authority has details of all the underlying transactions made by a business, the authorities can determine what the VAT position of a business may be without the business even being required to submit a VAT return, which could be the future of indirect tax. An example of near-time reporting requirements is SII in Spain, which some of you may have heard of. Linked to this, more and more authorities are implementing specific electronic invoicing regulations where taxpayers are required to issue VAT invoices via government-controlled platforms. This requires taxpayers to have some form of interface with the taxing authority system to submit invoices via the platform, which are then reviewed and given specific unique identifiers by the taxing authorities before being sent to the purchaser for receipt and download from the government portal. Again, this mechanism gives taxing authorities the ability to access all transactions invoiced and purchased by taxpayers. The theory behind electronic invoicing and real-time reporting are essentially the same, as taxing authorities are seeking to control key elements of the indirect tax process, the VAT invoice being one of the most important that we see around the world. Examples of e-invoicing regulations include China's golden tax invoice system, and these rules are actually very prevalent across parts of South America and Asia, including systems in Brazil, Mexico, Korea, and Taiwan, to name a few. Within the European Union, there's certainly a move in this direction, but the first widespread example was Italy's e-invoicing rules that were effective from January 1, 2019. There are, however, proposals for other countries such as France to introduce these rules over the coming months. Some of the challenges of these rules is being able to appropriately configure ERP systems and integrate these with government invoicing solutions. Unfortunately, every country is a little different, so what we typically see are different solutions for different countries as opposed to a consistent global approach. Finally, we're seeing taxing authorities investing and utilizing data analytics capabilities to increase their abilities during tax audits. This is linked to other initiatives such as SAFTI, which stands for Standard Audit File for Tax. Under SAFTI, taxpayers must be able to provide taxing authorities with a predefined report for audit purposes, which can be then analyzed by taxing authorities using their data analytics tools to ensure there are no inconsistencies or discrepancies with the data and the VAT returns that were submitted. All of these measures demonstrate the importance of taxpayers being comfortable with their taxing decisions, the quality of data residing within their ERP systems, and having a full and complete audit trail in case of review from taxing authorities. And with those final comments there, that concludes today's presentation. Thank you everyone for joining us, and we will now do the polling questions.